Hey everybody, John here. I'm personally really excited to go through this video just because I feel like it's the first time that I can kind of speak directly to a lot of these conditions as to what's next, right? We've been talking about this idea of a bear market, this idea of a recession for a while now. The first time that I mentioned it in a video I talked about a crash on January 22nd, but I mentioned bear market by name on February 23rd as more of a hypothetical warning of the possible condition. But to me, like there's no room left for doubt anymore after equities are down 20+% and Bitcoin's down like 60%, and we're about to enter our second straight quarter of negative GDP growth, and inflation is skyrocketing, and the Federal Reserve still needs to raise interest rates in order to try to preserve the value of the dollar, all while starving the economy while doing that. All of these things make me very confident in the statement that we are probably in a recession and we are definitely in a bear market, right? So, again, I've been talking about this idea. This is something that might be happening, that's on the horizon, that conditions are starting to look ugly, but now I can say we're here. And I think we've been here. And I think my past few videos, my tone has been we've been here. But the best part is that now we can all admit we're here and we can all just come to grips with that, and then we can respond to it, right? And I think that's the value that I try to bring about doing these streams, about having a YouTube channel, is so that you can respond to these conditions in the best way possible to set yourself up to be in a better spot in the future, right? There's a lot of lessons to be learned, not only from this past bull cycle and what the past couple of years have taught us with banking policy, inflation, bull markets, things like that, but I think that we can also look back decades and see what have prior generations gone through, when inflation was high, when there was a tech bubble, when stocks got overextended, when we entered a recession. All of these different things, hopefully I have some insight in order to help you weather that storm a little bit. So the first thing I want to start off with is actually to look at a video that I posted a little over a month ago now, May 8th, called How to Survive a Market Crash. And hopefully my audio plays through my computer here. If it doesn't, I'll say what I say anyways. So in the event that the audio didn't play through there, I said that the interest rates for the Federal Reserve need to stop rising. Inflation needs to get under control. The United States dollar currency index needs to stop rising, and global macroeconomic uncertainty needs to calm down a little bit. Those are the four conditions that need to happen for the markets to turn around. For the economy to turn around, that's a little bit broader of a question. There's a lot more factors that go into it. But for the markets to turn around, those are the four conditions that need to happen. So we're going to start off by looking at the inflation rate. And as we can see here, we are currently in the midst of the worst increase in inflation since the 1970s. Now, the reason that we are having such bad inflation, assuming you believe Milton Friedman's comment of inflation is always and everywhere a monetary phenomenon, is because we increased our money supply dramatically in a very short amount of time. In meme vernacular, money printer went burr for way too long and way too much. And you can literally see that change in condition on this graph. I think it's even more severe if you put it on as a percent increase, but it's all the same stuff. At the end of the day, you can clearly see that in March of 2020, the Federal Reserve expanded the money supply at an unprecedented level. And due to that, we're now experiencing inflation at an unprecedented level. Now, the Federal Reserve has tools to combat inflation in the same way that they have tools to combat a recession. The problem is that when you have inflation and you need to contract the money supply, you are increasing your odds of either causing or exacerbating the recessionary conditions. And that is the rock and the hard place that the Federal Reserve has ended up in, which I believe the Federal Reserve's impossible situation posted 4 weeks ago, 3 weeks ago, rather. So the result of this then is the Federal Reserve, because they expanded the money supply too much and because inflation is rising as a result of them expanding the money supply too much, is they need to raise interest rates. What that does, if I can find the interest rate graph, there we go, is it makes money more expensive. By making money more expensive, you're pulling back on that increase in the money supply, and you're increasing the value of the dollar as to try to reel in inflation. Hopefully everything that I've said so far makes sense. If not, as always, leave a comment asking a question. I'm happy to elaborate further. So that's what happened. We were scared about the pandemic. We printed a whole lot of money in response. As a result, we have inflation. And because of that, we need to reverse course on that money printing, right? Here's that money printing happening right there, right? We had about 2.5% interest rate. And then we went down to functionally 0% interest rates. And because we went to functionally 0% interest rates, money was very liquid, markets increased, asset prices increased, housing market increased. And now that all of that's gotten overheated, the Federal Reserve needs to use the tools available to them, rather, in order to combat the inflation issue. Hopefully all of that makes sense. Now, when money's less liquid, it's harder for economic activity to occur. And this is where we're getting that slowdown in GDP. So we haven't had this Q2's GDP growth posted yet. But last quarter, we had a negative increase in GDP growth, and a recession is generally defined by 2 consecutive quarters of negative GDP growth. Right now, the outlook that we are going to have a positive quarter of GDP growth for this quarter is unlikely. Additionally, the unemployment rate for the longest time has been the lowest it's been since, I believe, the 1970s. Yep. So you see here, prior to the pandemic, unemployment was 3.5%. And it's actually gotten back down to that level post-pandemic. Great, right? We had this big job boom. A lot of people were able to get jobs, and I'm stoked for them. And if you see here, like, there has not been a point in recent American history where unemployment's ever been that low. The last time it was at 3.5% was July of 1969. So it's been a long time since we've experienced that level of unemployment. And that's great, by the way. Like, that by no means does this mean that, we have to have increasing unemployment, but we are seeing recessionary pressures. So that probably means that because we're at this very low rate, we probably will see an increase in unemployment. How big? I don't know. How long? I don't know. One economist fun fact about unemployment is that, which this makes perfect sense if you think it through, quits drop dramatically during unemployment, right? The amount of people that are voluntarily leaving their job position decreases quite a bit, but layoffs increase. So something to kind of keep in mind on when you're looking at the unemployment rate is, like, that doesn't necessarily, even though the unemployment rate might be recovering, that we still could be in, a recessionary area, or even though the unemployment rate's in an okay spot, we still could be recessionary. So those are kind of things to keep in mind on, keep an eye on, right? And just because you're working also doesn't mean that you're not, feeling the pressure of $5 gasoline and 12% increase in grocery store costs, and just generally speaking, 8.5% inflation year over year, probably about, I think, 12 or 13%. Don't quote me on that, since the 2020 pandemic started. Radical idea that would never happen, but might work. The U.S. government sells gold to back the printed money. So the gold standard is interesting, right? Because that's what we were on until the 1970s, and I think one thing that you can really draw an interesting parallel to is that wealth inequality started to increase significantly once we got off of the gold standard. And I don't think it's because like gold had this inherent value that made it really important to keep on a central bank balance sheet, but rather we were weighting our currency in something. And now we're not really anymore. And we're practicing modern monetary theory. And I think I've mentioned this before, but even though most people in my field don't necessarily hold this view, I think modern monetary theory has an effect on income inequality. And we'll get into this a little bit more, because we are going to talk about, recessionary pressures and things like that. But long story short, you're in two groups during a recession when we, make money more liquid. I'm in a bad situation, I need to spend this money to survive group, or I'm not in a bad situation, I'm going to take advantage of these low interest rates to buy property, invest, things like that, right? And that compounds over time the more times that you go about these interest rate cycles, right? So if you're on the winning side of that liquidity equation where more money's flooding the market, then you're going to use that to your advantage to grow your wealth. If you're on the losing side of that equation, then all you're doing is just getting by, and you're potentially getting by with record high inflation. So I want to talk about a couple things on just how to get through this area of fear and uncertainty, because we have been here before. The first thing that I want to note is those 4 rules that we talked about in the beginning. Actually, I'm not going to draw this out just because that got really messy last time I did it and I ended up regretting it. So rule number 1, you need to look for the interest rate to at least plateau, right? You don't necessarily need it to go down, but in order for the markets, the investment aspect of this, to start recovering, you do need to see it plateau, right? So this, could do that and start to level off. And once it levels off, then we can start having a conversation about markets being in recovery. The Federal Reserve will not do that until inflation starts going down. So the Federal Reserve 100% will be raising rates until, so many indexes here, my apologies, until this graph starts to behave, right? Until we start doing something like that or like that, rather than doing this, right? Federal Reserve will pivot on increasing interest rates and making money less liquid as soon as inflation peaks and starts to head its way back down. And the logic of this makes perfect sense, right? You're making money less liquid. You're trying to make it more valuable so that inflation isn't occurring. But the result of that is people have less access to money, and that has a recessionary pressure. High interest rates don't necessarily mean you have to have a recession, but you'd like to have high interest rates during a growing economy so that you can let off the gas pedal when the economy is in decline. And instead, we have this inflation problem. So the Federal Reserve is laying onto the gas pedal to try to reel this in as quickly as they can before the economy does officially go into a strong decline. The third thing that I'd look for with the markets is the dollar index. Now, this is a fun knockout punch. Even though inflation is increasing, the value of the dollar is also increasing because of the fact that our monetary situation isn't quite as ugly as some other countries, and that's what this is being weighted against. And second, the Federal Reserve so far is at least partially achieving its goal of making the dollar more valuable. The problem is that they're not doing it quickly enough, and they probably should have started trying to do this a little bit sooner. I personally think that the dollar has room to move up to this previous high in the early 2000s. So right now the index is at 105. When it hit its pandemic low, it was at 89. And this top is a 121 right here. So I think the dollar index has essentially is about halfway done in its relentless path upwards. And when the dollar's in a relentless path upwards, investments, stocks, crypto, whatever, are usually bearing the brunt of that. And we're seeing that. Strong dollar index rally, stock market doesn't look so great, right? So if you're an investor, those are the conditions that I would look for, right? And don't get in the habit of just buying every dip you see, because if you were doing that, then, the dip has kept on dipping. So I would wait, especially if you don't love keeping an eye on the markets all of the time, which to some people, these are, relatively boring. And I get that. So you don't want to keep your eyes glued to the markets. But if you start to hear, inflation starting to come down, the Federal Reserve's looking a little more dovish rather than hawkish, those are kind of the signals you're looking for that the markets might be turning around, and hopefully maybe the economy's turning around at the same time. Okay. As far as recessionary tips go, I'd say the biggest thing is to look over your monthly expenses and take a good hard look at what you need and what you don't need is one thing that can absolutely help. First. Second thing is to make sure that you have a certain percentage of your paycheck that you should view it as a monthly bill, even though it's not, that goes into savings. And if you'd like to invest, then goes into investment. So that's not financial advice, right? So for me personally, 15% of my monthly income, no matter what, goes to savings and investments, right? I consider it a bill, right? It's not something you can't just skip your car bill for a month. You can't just skip your rent for a month. I don't skip putting a certain percentage of my income into savings and investments. And I think that's a good habit to be in regardless of what the economic conditions are, but it pays massive dividends in recessions because you don't know what's going to happen, right? I'm sure you didn't expect $5 gas. You probably won't expect $7 gas. You probably, don't expect to get laid off, but the unemployment rate might be showing that those things are happening more frequently. And don't get me wrong, I take no pleasure in saying that there's a chance that, people are going to get laid off as a result of this. But when that situation happens, you don't want to be caught with your pants down, right? You want to have contingencies for that. Quick question. Even if the market is going crazy, would you still be dollar cost averaging? So yes and no, right? If you and that's why I mentioned kind of, and sorry about these advertisements. I'm saving on my balance sheet by not spending a couple $100 for the premium version of this amazing program called TradingView. But I would say that you'd look for conditions in which it might not be so risky to dollar cost average, right? And like for me personally, right, I'm very crypto heavy in my portfolio, and I'm pretty open about that. So yeah, it hasn't been a great few months, but because of the fact I keep an eye on the markets and I have contingencies and trading plans, I haven't felt the burn quite as bad as some other people. But so I use this logarithmic regression band, and I previously had this pink band colored, and I just I decided not to shade that in anymore. Just have these two lowest bands shaded, because that's me, learning lessons about my investment strategy. But my rule was that when you're in the shaded region, you dollar cost average, and with each logarithmic band that you drop under, you dollar cost average heavier, right? So when we're in statistically lower ranges for Bitcoin's general price history, I was getting more aggressive in my dollar cost averaging, right? So let's say, this was 5% of my paycheck, and, that's an amazing 5%. This one was 10%, and this one was 15 or something like that. That's not the actual numbers that I use, but that's just a way to look at it. Now, not every investment has this beautiful logarithmic growth aspect to it, of this just trending towards like a what's referred to in economics as like a steady state, where it just is going to slowly monotonically make its way up in accordance with these regression bands. So instead, you can use moving averages. And the best part about moving averages is you do not need to keep an eye on them often, and you do not need to be, an expert trader or quant in order to use them. So I use weekly moving averages. And the rule is that when you visit a long-term moving average for the first time in a long time, you can be more aggressive in your dollar cost averaging. So long story short, yes, I think dollar cost averaging, even in a downtrend, is a good strategy. But there's always the option of, if you feel like we're heading into a worse downtrend, or that downtrend is to continue, or we're heading into a recession, maybe cash is king right now. The Federal Reserve is trying to make a pretty strong statement that the dollar should be more valuable. And the dollar right now is making a strong statement that it's more valuable. And because of that, right, you don't want to fight those pressures. Maybe it's okay to put more money into savings, or, something that's a little bit more risk off than your investment, but still have that dollar cost average, right? You're just dollar cost averaging into cash and savings rather than dollar cost averaging into your investments. And then when you feel like market conditions are, looking up, or potentially looking up, or we're just going sideways for months at a time in an accumulation phase, then absolutely that you can aggressively dollar cost average, in a more risk on environment. So the Dow, for example, doesn't visit its 200-week moving average very often. In fact, we haven't touched it yet, and I'm sure we have it. We're bound to touch it at some point, just with the conditions look. But we dropped beneath it in 2009. We touched it in 2011. We touched it in 2016. We touched it in March 2020, and we're about to touch it now. Every single one of these represents a significant buying opportunity. I mean, you can look at the rallies that we got off of going beneath the 200-week, right? I'm not going to count this one because we went so far beneath the 200-week for that one. But this one, you had and again, this is the Dow we're looking at. So this is a pretty slow moving index. This bounce got a 74% move. This bounce, actually, you want to go to the top here, got a 90% move. And at this bounce, if you measure from the 200-week moving average, got a 56% move. If you measure it from the bottom of that move, it got over 100% move, right? So I know personally, like, hey, I'm dollar cost averaging, but I'm getting pretty aggressive with my buys when we're at these long-term moving averages. So hopefully, I didn't get too lengthy with that explanation, but that's just kind of the way to look at it. And one thing that I also want to show too, which I think everybody will kind of find interesting, is I am going to tag let's move to the monthly chart, and let's make the S&P logarithmic. Sorry, I got to do a bunch of scaling wackiness in order for all of this stuff to look somewhat neat. And then I'm going to switch this to a line graph just to make it easier to see and get rid of the moving averages. Okay, cool. After all of that prep, we can do some analysis. So one thing that's worth looking at, this orange line is inflation, and this white line is the S&P 500. Inflation topping, mark the bottom of that move. Inflation topping, marked a smaller bottom, not quite as significant, so take it with a grain of salt. And in my opinion, inflation has not peaked here, right? We still got a bit to go, but when it does peak, it will probably be pretty dang near the bottom, right? So personally, again, if you're like not keeping an eye on the market super often, I would highly not recommend, but I would definitely be keeping an eye on inflation, right? Because once that starts to roll over, we might be looking into a better economic situation, hopefully. And I do want to address the crypto market real quick and just get the elephant out of the room. Yeah, this is brutal, super brutal. And it's gotten to the point on the internet where like Bitcoin investors are like, being told they bought into a bubble and getting made fun of and blah, blah, blah. And it's all the exact same sentiment that happened when the floor fell out in 2018, right? But the thing with Bitcoin is that this is not the first time that we've been here at all, not even close. And it's just par for the course. And I think like most people, when they're talking to somebody about getting invested in the crypto market, get this disclaimer all the time. It's risky. You have to have a stomach for volatility. You have to be okay with 80+% drops. Every single person that approaches me about getting into crypto, I give them that spiel, right? You have to have a stomach for just absolutely brutal times in the market. In 2013, Bitcoin went from about $900 to, I'm actually going to switch to candles here. Sorry. It went from $1,200 to, at its bottom, about 150. It was a negative 87% move. By the way, earlier that year, it also had a negative 75% move. Right? Both of these tops happened in 2013. And we go to the 2017 peak. By the way, from that bottom to this top, just, if you want to talk about gains here, right? I mean, what is that? 13,000. It went from a couple $100 to around $20,000. So whatever that is. And here's the thing: is people in 2017 that were buying, here, they kept saying over and over again, "Man, I wish I got into this in 2014 when it was a couple $100." And then that top hit. And from 2017 into 2018, Bitcoin saw an 85% drop. And then, a rally of sorts happened. This was actually like over a 100% move. It went from significantly over a 100% move. I think it went from like $3,000 to about 13,000. Yep. And then from that 13,000 peak, it dropped another 75%. Back or down to around the range that it dropped in 2018. And when it finally went on a parabolic rally up into the $50,000 and $60,000 range, what you heard over and over again was from so many people is, "Man, I wish I either bought or stuck around back in 2018. And my theory is that we're going to accumulate for a long time. This is just a theory. We're going to accumulate for a long time, probably a year, maybe two, long enough for people to absolutely lose their interest in this market. And then we'll go to a parabolic rally somewhere past $100,000 probably. If you look at a logarithmic regression, right, this is where that top was. Let's drop one log band down and just kind of extrapolate from there, right? That's about the trajectory of that log band. And we'll do that with this one too, just to kind of give like a general idea of price range. Looks about right. We could be close to $200,000 4 years from now. Could be, if, barring any sort of crazy other market conditions, or we couldn't be. But what I'm trying to say is that if we do make it to those prices, if we do make it into that $100,000+ price range, what are people going to be saying? Me saying, "Man, I wish I bought Bitcoin in 2022 and 2023 when it was $20,000. It's the same stuff over and over and over again. The time scales are different. The prices are different. The macroeconomic conditions are different. But and for that reason, by the way, because the macroeconomic conditions are different, I think we have more room to drop than we regularly would from these previous drops. I think we can go as low as 13K, worst case scenario. If you actually look at the log bands that I, use, we're beneath it. And when we've been beneath it, we've only been beneath it temporarily. That's right. The log band was at about $5,000 back in March of 2020, but it wicked all the way down to like mid 3,500. So while the log band right now is at around 22K, like we could spend some time much lower than that, right? By that same metric, right? That's an additional 30% drop from there. If we were to drop an additional 30% from where we are right now, look at that, right at 13K. I'm not trying to say that I'm like amazing at technical analysis or anything. I'm just using prior data to maybe inform the situation. So we could go that low. And if we do, I'm going to be buying a whole lot of Bitcoin. But that's just me. And again, people will forget about it. People will not care because it's going to go for a year, maybe 2 years before it looks bullish again. But when it eventually gets into that $100,000 range, people are going to say, man, I really wish I took advantage of this opportunity, right? So Bitcoin and many cryptos were considered a hedge against inflation. I don't think that turned out to be true, but I want your take on the idea that crypto is a hedge against inflation. So listen, as far as other altcoins, I don't know who's trying to tell you they're a hedge against inflation, but I don't think that's accurate for 2 reasons. One, most altcoins are businesses and they have business interests, and they also don't have a fixed supply, right? So you can increase the supply of a lot of altcoins out there. And I think you're investing in a business more than you're investing in a coin, right? Bitcoin's different because Bitcoin is an anonymous creator, and that anonymous creator is not trying to turn Bitcoin into a profitable business. He just gave the tech to the world and then disappeared and said, do what you want with it. So as a result, Bitcoin has qualities that are different from all the other altcoins. And I have altcoin investments as well. But here's one thing that I will caution you of is that altcoins will 100% bleed to levels that you had absolutely no clue they could go to against Bitcoin during a bear market, period. Like, let's take a look at Ethereum, right? When Bitcoin dropped that, 85% drop from 2017 to 2018, Ethereum dropped almost 95%. And Ethereum's the second most popular crypto out there, right? So some of these altcoins that you have, they might recover. They might not, but they might recover if you think that they're a good business with good fundamentals. So sorry if you invested in Dogecoin and Shiba. I tried to warn you. That's your bag to bear. But if you're investing in Ethereum or Polkadot or Cardano or, a lot of these other coins that actually are businesses trying to, provide utility to the world that people will think is worth investing in, those can recover. But before they recover, they're going to bleed against Bitcoin. And this is Ethereum's valuation against Bitcoin that is dropping heavily and is probably going to continue to drop, right? But if you look at these tops previously, this is against Bitcoin. Bitcoin's the denominator of this chart right now, not the United States dollar. And you can see we have this bleed here, but from January of 2018 to September of 2019, so for a full year, Ethereum did nothing but lose value at a further rate than Bitcoin lost value. So my advice to you is be really cautious about where you want to put your money in the crypto market right now, because altcoins are super risky. And the crypto market in general is incredibly risky. And chances are is altcoins won't increase in any sustainable way against Bitcoin until Bitcoin looks bullish again. And if that's the case, then you might as well just be investing in Bitcoin only right now. Right now, I'm not investing in any new altcoins. I'm not telling you what to do. I'm not telling you what to do whatsoever. But I am personally not investing in any altcoins. I'm exclusively investing in Bitcoin. Now, to address the inflation hedge conversation, which I also think is a really important conversation to have, I am of the opinion that Bitcoin absolutely 100% without a doubt served its purpose as an inflation hedge. And here's why. First of all, what is it to hedge, right? So we're going to go to hedge against meaning. We're going to go to Investopedia, and we are going to go to this definition right here. Hedging is somewhat analogous to taking out an insurance policy. If you own a home in a flood-prone area, you want to protect that asset from the risk of flooding. To hedge it, in other words, by taking out flood insurance. In this example, you cannot prevent the flood, but you can plan ahead of time to mitigate the dangers in the event the flood did occur. To hedge against something means that you are planning for that condition in the past in the event that it does occur in the future. All right. So that's what it means to hedge. So Bitcoin as an inflation hedge by the time inflation truly started increasing at this level that was unsustainable, which we'll put the marker on it, right? I mean, what, you guys take your pick. Do you want me to say January of 2021 or February of 2021 is when inflation started going crazy? I'll just take February, right? Because that's really when that slope shifted significantly. By the time that had happened, Bitcoin rallied. And I'll just take the weekly close. 1,000%. 10x. If you invested in Bitcoin, if you hedged against inflation even a year prior to that inflation really starting to take off, Bitcoin absolutely served its purpose as an inflation hedge. And now what happened, and this is the part that I keep trying to illustrate, is if you successfully hedged against inflation with Bitcoin, what would you do once the inflation started kicking in? You're going to take profit back into the United States dollar so that you can actually use it in your day-to-day monetary activities so that you don't feel inflation quite as badly, right? So when people say Bitcoin failed as an inflation hedge, I disagree, because I think anybody that planned on inflation occurring in the future and made their investment decisions properly in the past to hedge against something, to prepare for the flood, they were in a great situation to take profit once the flood occurred, right? Don't try to get insurance after the flood, right? It's like you have a pre-existing condition or your house is already damaged, you're going to have trouble getting insurance. If inflation's already occurring, you're going to have trouble finding hedges against it, right? You have to anticipate it. So, and I know so many people that, started investing in Bitcoin around here, saw this awesome run up, and took profit to buy a car, buy a house, any of those other things. So they invested into a hard asset in a time when the dollar is struggling to hold its value. So, as a result, they properly hedged against inflation. So I'm sure you guys get the point. I've had quite a few discussions with quite a few people about this particular debate. So I just wanted to make sure I did my due diligence in explaining what it means to hedge and if Bitcoin was properly a hedge against inflation. And for that reason, I think people, are probably done profit taking, because it's probably served its purpose to, all the people that took profit in this range as far as an inflation hedge goes, right? So anybody that's taking profit at this point is just because they're scared, or taking losses, because there's a ton of people doing that. I don't want to touch much more on the crypto market right now, I think, because look, I mean, we're at the lowest logarithmic regression band that I've used. We're at, the lowest long-term moving average that I use. I implied that further downside might be ahead, but in general, like, people that buy at these prices don't regret buying at these prices 3, 4, 5 years from now. So I'll just leave it at that. I want to take, so we looked at the unemployment rate already and how that might be going up. I do want to take a look at the global supply chain pressure index. This is actually starting to come down, which is great. Now we just hope it has to continue to come down, right? We talk about macroeconomic uncertainty. We can talk a lot about that domestically, but there's also a war going on in Russia and Ukraine that's disrupting not only European, but global supply chains. And China also had, a really severe lockdown recently, where people weren't allowed to go outside and were chained into their apartments and stuff like that. A bunch of crazy stuff. So supply chain slowed down. When supply chains slow down, prices increase, right? So, and commodities have continued to increase, by the way. But hopefully, if this gets back below, levels from a year ago, and we actually start to look like we're in a better spot from supply chain pressure, that might be a great indicator that, these recessionary pressures are starting to chill out a little bit. I think it's going to take time, probably another 6 months before I'm really feeling like I'm in okay. But if this is a continued downtrend, I'd feel pretty good about that. If you want to extend this out, right? We've talked about this. Downtrends are denoted by lower highs and lower lows, right? And when you're investing, you don't want to see a downtrend. You want to see an uptrend, right? You want to see higher highs and higher lows. When you're in a downtrend, you see lower highs and lower lows, right? And what I mean by that, here's a high. Here's the next high, but that was a lower high than that one. Here's a low, and here's the next low, which is a significantly lower low than that one. So we can establish that's a downtrend. Now, for something like global supply chain pressures, you're rooting for a downtrend, right? So we have a high, we have a low, we have a lower high. I'd love to see this go into a lower low, and maybe we start building confidence that supply chain pressures are starting to chill out. This one's scary. This is the University of Michigan Consumer Sentiment Report, and believe it or not, we're at the lowest level ever since this index has existed. So that's cool. Personal finance sentiment is dropped 20% just this last month in the past 30 days. So that's pretty interesting. Worth keeping an eye on to see when this improves. I mean, this could be, a bottom, but if it keeps going lower, that's crazy, because again, this sentiment report has existed for, it looks like 60, 70 years now. So pretty interesting. But yeah, I think as far as just macroeconomic indicators, talking about markets, talking about recessions, that's about all I had for you guys today. So remember, look for the Federal Reserve starting to chill out on their hawkishness with the interest rates. Look for inflation start to come down. Look for the dollar index to stop rallying, and look out for global macroeconomic pressures to start to subside and maybe stop being so anxiety inducing. So those are kind of the things that you're looking for when weathering a bear market and or a recession. And you can do additional things like take a look at, unnecessary expenses for your personal finances. Maybe you don't need 5 streaming subscriptions right now. Maybe you can just enable the streaming subscription when you want to watch something rather than just paying every month for it. And then additionally, you can take a certain percentage of your paycheck every month and put that into savings and or investments. These are just options to help you potentially weather the storm a little bit, right? Of course, I'm going to stick around we're going on 45 minutes now, but I'll stick around for a little bit to answer questions if anybody has them. Both Brian and Chris, I mean, you guys' questions were awesome. They gave me a lot to riff on for a little bit, and they were, I think, fantastic questions to be asking. To me, it's really cool just because of the fact that, I can tell you've been tuning in from time to time on some of the stuff that I have to say, to be asking some of those questions that you're asking. So that's super rad. My throat's really been super dry this stream, so I apologize. Doesn't look like any new questions are coming through, so we'll probably wrap it up at that. Again, thanks a lot. This will get better. And that's, I think, a really important thing to just remember, is that like this is not any different from any other recession or bear market that we've been through. And I would say that, if this is your first major one that you're living through, like, me, this is my first time as an adult living through it. I think the, data science that I do, the education that I have, all of these things make me feel a little less anxious about it. And I have a plan moving forward. And I can't tell you what your plan should be, but I would say that it's beneficial to have one so that you also don't feel as fearful and anxious about these conditions. Realistically, these conditions, in my opinion, will last at least another 6 months. They could last 2 years. So you just want to make sure that you're not in a situation where, if these kind of pressures do continue for another year, that you haven't put yourself in a bad spot because you decided to not act on some of the information that you have now. So again, just make sure you have a plan. That plan needs to be catered to you, but there's just certain considerations that will hopefully help you out. It will get better. We've been here before. It's been much worse in the past, both from an inflation standpoint and a recession standpoint. So just hang in there, and hopefully, both from an economic perspective and a market perspective, the party can continue in a year or two. So thanks again for tuning in, guys. I hope you all have a great night, and stay safe out there. Peace.